equity return expectation. How do we calculate the rate of return required? What is the one method that we all know? Capital asset pricing model, right? So some of you haven't attended this, but I think a lot of you know CAPM, right? So this is how we get the R, return on equity requirement. So when I'm doing the DDM, Gordon growth model, what is the valuation? My V0 is equal to D1 by R minus G. How did we get this R? Is from CAPM, right? So this is how we got it. And this equation, CAPM equation is what? Anyone knows CAPM equation?
R plus beta.
Yeah. Beta into?
Expression of the open minus
RM minus RF, right? So this is typically how we are calculating the rate of return for a lot of our calculations. So in your examination, they might sometimes not give you the R. In our calculations, I have given you the R directly, but in the exam, they might not give you. You might have to calculate the rate of return. So let's think about why this equation is existing, right? Now, let's say who has a lot of money here? Everyone has a lot of money. So let's say you have a lot of money and you want to invest, right? What are your options? First thing, what do you do? What is like the first easiest way to invest? FD. Okay. So what Mohammed is saying is we will go to FD, safe investment. Maybe I'll go to this SBI branch and put some money. And usually up to 5 lakhs of savings account, government gives you a guarantee. Like even if SBI goes down also, the RBI gives you guarantee that they will repay your first 5 lakhs, right? So it is risk-free pretty much, right? So now if you go, let's say you're investing for 6 months or something, you're getting some 4% return. This is risk-free return, okay? So I call this as RF. And the risk is zero. Risk is standard deviation. It is zero, right? We can also have other measures of risk. I'm going to use a slightly different measure than standard deviation. I'll talk about it, but we will call this risk as beta market risk. This is total risk. Both of them are zero for FD. Because if Nifty goes up 10% or down 5%, is the value of FD going to change? No. So there's no risk for this FD that is in relation to the market. So the beta of FD is zero. Risk-free rate is 4%. This is now Honesh says, you know what, 4% is all for like people who don't have anything to do. I want more return. Like I want more return. 4% is fine. You guys can keep it. So what he can do, he can go to the market. He can say, I will invest in market. Nifty has typically given more than the risk-free rate. I am an achiever, high achiever. So I want like 14%, right? Market return is 14% on average, 13 to 14%. So I want that. Now, what is risk? His risk is beta is 1. So he's investing directly in the market. So that is 1 unit of market risk. So his beta is 1. So if market goes up 10%, his return will go up 10%. Markets come down 10%, his return will be down 10%. Exactly syncing with the market risk. So beta will be 1. So for taking on this beta, how much excess return is he getting? 10. Very good. So the excess return, RM minus RF, is 10. Because that 4% anyway, Mohammed, without taking any risk, he got. Now Honesh is taking that risk. So he needs to get paid more excess return. So this is called as, for the market risk, he's getting a premium. Market risk premium, which is RM minus RF, and that is 10%. Now this is all fine. But then there are people who want even more, right? Onish is not satisfied. 14% is fine, but I can do better in life. I want to do better in life. So he's saying, find me the stock that will give the maximum returns, right? And he's come up with some stock. I don't want to name stocks here, but let's say he's come up with a stock, and that stock is going to give, maybe it's a infrastructure stock, it's going to give more return. So he's saying, how much will that stock give? Now, let's say the risk of this stock is 1.8 times market. Okay, 1.8 times, let's assume. That means if market goes up 10%, the stock will go up 18%. It's indexed, hyper indexed to the market. Okay. So now what is going to be his return? Tell me. How much will be his return? If the stock is having a 1.8x, is having a factor, how much? So, yeah, go ahead.
22%.
22% is the total return. Very good. How did Honesh calculate this very quickly? So he said, I'm going to get 1.8 times the return, which is my risk premium. Obviously, I will get the risk-free rate. That is, anyone will get that, right? So that I will anyway get it. So 4% plus 1.8 into 10%. So that is my return of 22%. So this is your beta of the security, and this RM minus RF is your market risk premium. Together, beta of the security multiplied by this is called as the security risk premium. Okay. So the more risk you take, the higher the return. Obviously, it will cut down on the downside as well. In case the market goes down, then you will also lose more. But if you are willing to take on that market risk, you will also gain on the upside. So this is how we calculate. So for this security, right? So this security, the expected return is 22%. So this is a way to calculate the rate of return, required return. This is a single factor model. I'm only using one factor. What is the factor? The only factor I'm using is the market factor, the market risk. I'm not using anything else. We will see multi-factor models later on. Formula for calculating this, the cost of equity required return is RF plus beta into RM minus RF. RF is your risk-free rate. RM is your market return. Beta is your market risk. And some people won't be satisfied. Honesh will say 22% is still not good. I want to leverage. No, you can also leverage. We'll see how you can leverage it and get more returns.